So we just got a hot jobs number full of holes. Next week, we have a Fed meeting, CPI, PPI, so much stuff coming hot and heavy. We got to talk to Mr. Dan Bird. And let's be clear, I want to give him his flowers. He talked about the the unemployment rate going to 4%. He nailed it. So Dan, congratulations. Damn it, dude, you got another thing right. You're on a roll.
Yeah, I'm gonna have to start put a bunch of t-shirts on
Collection
eBay or something.
Exactly. So what happened last week? Let's talk about jobs number. The week last week, Nvidia's at crazy highs. The 10-year note.
Yeah, Nvidia split adjusted on Monday.
Yeah, it'll be split adjusted Monday. Big deal. 10 for 1. Nvidia's gonna crash from 1,300 to 130 bucks on Monday or something like that. But, it is.
Before we get into the jobs number, let's talk about what you've said about it. It's kind of funky, funny.
Yeah.
I don't know the word you use, but
it has some holes in it. It's not as strong. The headline number was strong, but I don't think it's nearly as strong as it really looks.
Yeah, so we exchanged some text on that when it came out. Mm-hmm. And my opinion is I don't really go by the jobs itself.
Right.
The 160 versus 270, whatever it was.
Right.
Because number one, during an election year, I think it's rigged. Okay. It's not supposed to be, but it's just kind of funny how the monthly adjustments every month keep adjusting it down after the headline comes out.
Yeah, nobody
reports that. But no one reports that. Right?
They do not. It's a footnote.
And the JOLTS number has holes in it too.
Yeah.
Did you see last week they came out and apologized because the JOLTS number has been wrong?
I think I missed that, but that does not surprise me.
Wrong because it's not accurate. They do an assessment of how many jobs are out there based on what's out on job sites and things like that. Mm-hmm. But when you actually talk to the companies that are posting those things, they've been finding that the companies are saying, yeah, we put it out there, but we don't really have that job.
You mean that there could be a job opening out there and there's not actually a job and they just forgot to take it down? Tell me it's not so, Dan. Tell me it's not so.
Well, I don't think it's so that they forgot to take it down.
Just not really there. Yeah, it's pretty wild. Yeah, I mean,
I think the JOLTS number has holes in it too. So
I agree.
I don't think, and the ADP number for that matter.
Oh, the ADP numbers. Yeah, it's just a mess.
So I don't even consider those, frankly.
So you only consider the unemployment rate is what you look at.
That's right. The unemployment rate to me is the important one. That's the only one that really matters.
Yeah. So let's talk about that because people may not realize this. The numbers that came out Friday, the 272 and the 4%. Those are actually two different surveys.
Yes.
One is called the household survey and one is called the establishment survey. One is talking to Americans. One is talking to business owners. And one of them is more likely to include double counting than the other.
Right.
So you like the household survey because somebody is actually talking to an American saying, hey, do you have a job? Yes or no? Right. That's the 4%.
Yes, that's right. That's the one I think is more accurate, more representative. Let's put it that way.
So that's interesting because I agree with you. I think it is far more accurate. It is far less. It's not adjusted. I mean, the thing that drove me crazy about Friday's number and why I say it has holes in it is the 272. I don't know the exact number, but it's something like this. About 225,000 of it was the death birth adjustment. Yes, we are living longer. Yes, we are working longer. Yes, birth rates are down. All of those are factually correct, but I know how these numbers are managed. And simply by making that adjustment, bingo, bango, we're up 225. That's not real, people. I mean, that is such garbage. If that number was not in the number, we would have reported a $48,000 or $48,000, 48,000 person. We still would have had growth, but it would have been a massive miss. It's just
so. What does it mean every month when they adjust the previous month down. So I mean, more people
Well,
died
first,
month.
no. So again, so first off, it's not every month. Let's not hyperbole. 9 of the last 11 months. So let's use the real number.
During an election year. How convenient.
Shocking. Shocking. Well, it's funny. I looked at that. I looked at 6 months ago. We were on a string of 6 months in a row of down. So I actually looked into this. And historically speaking, the jobs number, the number that we're talking about, it has always had strings of misses either way at inflection points. And I think that's the important thing. I think the US economy is going through an inflection point, and these PhDs, these economists,
Right.
I don't think, given that they're doing math, I don't think they are purposefully making mistakes. I just think their models don't change as the economy inverts up or down.
So
And
it sounds
that's
like
the problem.
a divergence to me.
It's a divergence. The economy moves faster than their models,
Right.
in my opinion. And I think
Right.
their models are wrong. Don't get me wrong. They irritate me to no end. But I don't think it's malicious. I don't think it's because of an election. I think it's more about the economy's turning and their models don't keep up. And oh, by the
Yeah.
way, yes, I understand we have an election 11 months, but I don't think the election means anything to the PhDs playing with these models.
Yeah, that makes sense to me from a math perspective and a data perspective. A divergence like that makes sense. It's a lagging indicator, basically.
Correct. And again, if you go back and look history, they are equally wrong on the other side. Like when the economy comes out of it,
right.
they're wrong on the other side. They got 6 months in a row of being too low.
That's how divergences work. You can have positive and negative divergences.
Exactly. So that's what I think it is. I don't think it's malicious because they want Biden to be elected. I think these PhDs are so geeked out on numbers, they don't even look up, right? I don't,
they don't even know who's president.
Yeah, probably, right? So again, I think it's just their models don't work at inflection points. And if you're paying attention, that means we got a nasty inflection point ahead of us.
Yes, exactly. Yeah, that's what divergences usually mean. They don't tell you when, though.
No, they don't. This one's gone on longer than expected. Yeah.
Right. So let's take a look at the jobs number, because I want to talk about that and CPI, and then I'm going to change one of my opinions.
Oh no.
Yes.
Oh no.
Oh yes. Hang on, let me share my screen.
Just so I'm clear, what are we changing your opinion on, just so I can be ready for it?
When the first rate cut will be.
Oh, all right. I'll be ready for that.
So just let me step you through my
Sure.
the analysis that I did last couple of days.
No problem.
All right. So this is my website, breakpointtrading.net. By the way, we're coming up on 1 year that this is.
Congratulations.
We had our July 16th was the big training.
Wow, 1 month away.
3-hour training that we did, right?
Yep.
And I actually created this for that training. So I was actually building it in June last year.
Wow.
No, I've added a lot to it. I had one subscriber send me a note, said, I love looking at your website because I always trying to find all the new stuff you've added. It's like an Easter egg hunt.
Easter egg hunt.
It's very cool. Anyway, this is the newsletter. We're going to take a look at that in a second. And if you want the newsletter for free, just go to breakpointtrading.net, click on this little button right here, or all the way at the bottom, do the $0, no credit card required. We don't share emails. And then you'll get alerted. You get a reminder that the newsletter is available. So let's look at first the unemployment rate, which is one of my 3 recession watches.
Yep.
And I listed these in the text that I sent you.
Yep.
Basically in this order. So this is the order I think it's going to go in as well.
Okay.
First one will be the unemployment rate. So there's what it looks like. I added in the Fed rates behind it.
I see it.
This black line right there. So you can kind of compare the unemployment rate to Fed cuts and Fed hikes, that type of thing.
Yep.
Okay, so right now, according to the Somme rule says recessions start when the 3-month moving average, which is the red line, rises by more than a half a point above the 12-month, which is the green line. All right, the green line right now is at 3.77.
Mm-hmm.
Last month it was at 3.74.
Right. So it slowly moves. Yep. Mm-hmm.
Yep. And the red one is at 3.9. Okay, so remember that's a moving average. The actual number came in at 4.
Got it.
Right over here.
Yep.
But moving averages by definition are lagging.
Correct.
So that means the Somme rule to a degree is lagging, and that's why it says recessions start when the 3-month rises by a half a point above the 12-month, because moving averages are lagging.
Mm-hmm.
Okay.
And at inflection points, what this really points out that maybe people are missing is if the economy is turning, the 3-month average will move faster than the 12 month.
Yes, that's right. That's right. It's kind of similar to what we were just talking about with the report, the jobs report.
Correct.
So right now that puts it at 4.27 is the trigger, is the Somme rule. Meaning when the rate, and that's going to continue to go up, by the way.
Yeah, it'll move slowly.
Right now, if somehow it's spiked to 4.27 this coming month, then that means the recession is just about ready to start.
Mm-hmm. But in theory, it would be very, because again, given these are trailing, you really couldn't get a 3-month moving average unless next month jumped to like 7 or 8%.
Yeah, that's right. Yeah, it would have to jump significantly for it to move up that much.
That's quickly. Right.
Yeah. But you can look back here when the red line went above the green line in the past.
Yes. Once it moves quick.
It moves very quickly.
Yes. Correct.
So it's just starting to move. In fact, you can see where my arrow is pointing. This little arrow here, which is similar to these arrows here. That's pointing at when the red line crossed the green line. Mm-hmm. This one's moving much more slowly than it has in the past.
Correct.
However, other than the one just before COVID, and actually this one is even lower than that, it's actually starting from a lower point than it has in the past.
That's interesting. Okay.
Okay. So it actually has more room to move. Now I drew this red line across here, and this is completely my opinion.
Okay.
As sort of if we look back, this goes back 34 years. If we look back 34 years, I'm kind of take an average of where the lows, roughly where the lows were, or let's say the normal. Let's call it the normal employment.
Okay. So you're saying 4.5 or 4.6, something like that?
4.5. 4.5.
4.5. Okay.
4.5. Over this period of time, 34 years. Mm-hmm. It's not the average employment, it's normal employment. Average would actually be higher up because of these spikes.
Right.
All right. So normal employment would probably be more like 5, 5, or 6. But average employment would be more like 5, 5, or 6.
Right.
But I think normal employment, when that inflection point comes, it's probably around 4.5.
Okay.
All right. So somewhere between now, where we are right now, and 4.5. Now the Fed's going to start getting worried before it gets there. The Fed's going to, by the way, the Somme rule is a Fed governor.
It is. Yep.
Claudia Somme. So the Fed is going to start getting concerned about this before it gets to that 4.27 or whatever it ends up being. It'll be higher than that.
Yeah.
Okay. So keep that in mind. That's one of the reasons I've changed my opinion.
All right. I'm with you. So far, so good.
That and the fact that this has crossed, much sooner than it has in the past. It's crossed, it's already moved about 3 or 4 months, probably 4 months. Mm-hmm. Where these back here is only about 2 months.
Correct.
2 or 3 months. All right. So it's already started moving, but it started at a lower point as well.
Okay.
So that's one of the reasons why I changed my opinion. So will this continue higher? I mean, this is one of the reasons I thought it might come in at 4 as well. And I think each month it probably will go higher.
Oh, interesting.
I think it will be 4-1, and then it will be 4-2. So we're talking July and August. Maybe it takes as long as till September, but I think by September we're going to get a 4-2 number.
Okay, unemployment 4-2 September. Got it. Okay.
Right. Okay.
So just so I'm clear, the report in September, meaning the first week, or the September number reported the first week of October?
The number in September, which will be for August.
Okay, so
we've got
before September 7th. It's always the first Friday
right,
of the
month. This one was the May number.
Right.
July will be June. August will be July. September will be August.
Okay, so the first week of September, you're thinking we have 4.2 the unemployment rate. Okay,
correct. That's right.
All right.
By the first week in September, we're going to get. I think we'll have 4.2. It could be earlier than that, but I think by then.
By then, I like that call. It's a nice call.
Now,
okay.
The Fed meeting is on September 18th.
Correct, mid-month. Yep.
Right. Okay. So keep all of this in mind. Also, take a look at the rate of change down here.
Mm-hmm.
And I drew these vertical lines in here. These are the points where the Fed made their first cut.
Got it.
First rate cut. All right. And this one came at almost the same time as the unemployment started rising. This was about the same time. This one was a little after unemployment started going up. This one here was quite a bit before, but of course nobody could predict COVID was coming.
Yeah.
Okay. All right. So that's the second part of my recession watch.
All right.
The Fed rates. So these pink lines are when the Fed cuts. Fed cuts. Got it. And then there's a recession. Cut, recession, except for the 90s. The Fed cut in the 90s twice, and there was no recession. It wasn't until 2001. So, but remember, this is the green boxes and red boxes represent secular bull and bear markets. We're going to talk about that in the second video.
Okay. All
right. So that's the second part of my recession watch. Has not triggered yet. And the third one is the inverted yield curve. Also has not triggered yet. In fact, it's actually
moving away. Yep.
Yeah. And the pink one is the 2-year versus 3-month yield curve, which is also, it actually had gone above zero and just kind of hanging out at zero right now. But that one's pretty far away. So none of those have triggered. And you can see when it does, when it goes back above zero, we've got 5 months and 6 months until the recession. So, as I said, these I think this is the order it's going to go in.
Okay. I
think we're going to get an unemployment rate 4.2, then the Fed rate cut.
Okay.
And then the uninverted yield curve. And all of that will then be the prelude to the recession. So the uninverted yield curve, we've got about 5 to 6 months roughly. So just call all of this about between 4 and 6 months.
All right.
So unemployment rate, and let's say the first Fed cut happens in September, which is what I'm saying now. And I'll explain why.
So you've got a first rate cut September. That's the breaking news.
Right.
The market agrees with you.
Yeah, I did say December or November.
Right. You're moving it up.
But I'm moving it up. Yep.
Okay.
And the first reason is the unemployment rate. Like I said, the Fed's going to want to cut before the SOM rule triggers.
Okay.
Because when the SOM rule triggers, remember that rule says the recession starts when that rule triggers.
Yep.
So the Fed wants to anticipate that trigger and do it before the SOM rule triggers.
I like it.
All right.
Okay. All right.
All right. So the next thing, which is coming next week, is CPI. So let's look at headline CPI.
Yeah, headline was 3.4 last time.
Yep. And you did a nice job in trying to help people understand the 12-month base effect. And I have a chart here that lets you visualize it. So the blue box is the base effect, 12-month moving window. And the one that drops off in June is a very small one. In fact, it's 0.
Yeah, this is my concern. I'm I'm concerned we print 3.5, which is above expectations.
That's what I think we're going to print. Yes, I think it's going to be 3.5. So here's what's happened. Last month was 3.4. Month before was 3.5. Okay, the forecast was 3.4.
Mm-hmm.
The month before the 3.5, it was 3.4. So it went
Right.
3.4 to 3.5 to 3.4, and I think it's going to go to 3.5 again.
Yeah. See, and just going back to your call for September, I would be with you. I'm with you on the unemployment. I'm even with you with unemployment potentially being 4.2.
Yeah,
I just don't think the Fed could cut.
yeah. Let me finish my analysis here,
Okay, sure.
and
Sorry.
then we'll discuss. We'll agree to disagree.
No problem.
All right. So let's take a look at this. So went 3.4 to 3.5 to 3.4, and then the next one, which we agree will probably be 3.5. All
Okay.
right.
Mhm.
So if we look at the base effect back here, see this little tiny one right here?
Yep.
Or actually the one before that.
Mm-hmm.
Here's 3.4.
Yep.
Little one 3.5.
Yep.
The last one, big one, 3.4.
Yep.
This one coming up will be 3.5.
Yep.
Okay.
Yep.
And it's the morning of the Fed meeting.
It is. Yes. Wild day Wednesday. Yep.
So the Fed's not going to cut. I don't think they'll raise either. They'll just keep it where it is, but the market will not like the CPI going to 3.5.
No.
Right now, it's forecasted at 3.4.
Correct.
I don't think they'll even like 3.4, but it definitely won't like 3.5. Okay. So now let's move forward. Let's go to the July report.
Mm-hmm.
Also a small one. It's a little
Yep.
bit bigger than the June one. You see it there?
I do.
I'll just keep my plus sign right below it. So also a small one, a little bigger than June. We're going to look at the commodities here in a second because that's going to be an important part of all of this as well.
Yep.
So I think we've got June 3.5, July potentially, and depending on what commodities do, could be dropped back to 3.4 again.
Yeah. Okay. Let's call 3.4. Commodities seem to be softening.
Right?
Okay.
Right. And then we go to the next one. This is the August one. That one's looking a little bit better.
True.
So now we go to 3.3.
Mm-hmm.
Right.
Okay. All right. Sure. I'll play along.
Here's the September report. Huge one.
Okay.
This one could drop. This could drop to 3.1.
Okay.
The Fed meeting is after the CPI report.
Correct. In September. Yep.
Right. So the CPI report in September is going to show moving from 3.5 to 3.4 to 3.1.
Okay.
The Fed and the unemployment rate is going to 4.2.
Okay.
The Fed will say, okay, we don't want the Somme rule to trigger. We're cutting.
Okay.
And they're going to cut a quarter of a point there. They will not cut a half a point
Yeah.
in this
Not a half.
scenario.
All right.
If they waited till November or December, yes, they would cut a half or more.
Yes. That's my feeling is we're going to get a half in November.
Right.
Yeah.
And
I
then
just
they
don't,
cut.
I just don't know if they can
And then
cut.
they cut. And then they
Yep.
cut in September.
Okay.
And look what happens in October.
Yeah. Another decent one.
I think the October CPI will be below 3.
Hmm. See, that's exact. So I agree with all of that, and I think it's that validation we go sub 3 that gives them the November cut.
Yeah, I think they're going to do it in September. And when it goes to below 3 in October, they're going to run a victory lap.
Okay. All right.
See,
Absolutely could happen.
We did it just in time.
Yeah. Hey, folks, do me a favor. You've been watching this. You've been seeing Dan and I agree a lot the last couple of years. We clearly are off, and we're just off in one meeting. Let us know what you think. Do they cut a quarter in September, or do they cut a half in November? Leave your comments below. Just curious where you guys are at with this. I
Yeah,
like it.
I'd
Great logic.
love to see that. I love the comments and people weighing in on stuff.
I do like
By
the
the
fact
way,
they
after
usually
that,
agree with you. They usually agree with you.
So after October, November, December are small ones again.
Yeah.
So if we go below 3, we could actually go back up to 3.
We could tick up to 3. Yeah.
It could tick up a little bit more, and then we'll start dropping like a rock after that.
Okay.
All right.
Yep.
Now, before we leave this topic, let's look at the commodities.
Mm-hmm.
Because this is going to be a big important part of this as well. So the part that's highlighted right here is what next week's CPI is going to be reported on. Look at gas and oil.
Yep. Yeah, that'll help headline.
That'll help headline. It actually may keep it at 3.4, not 3.5.
It could.
Right. Copper was on a tear. Now copper's dropping off. Food is creeping back up again, but CRB is actually lower than the month started. So in general, commodities are lower than the beginning of the month. That's going to help CPI.
Yep.
So I hadn't even looked at this before this call, by the way. So based on this, I'm thinking 3.4 now. Next week.
Oh, you're going to go 3.4? I'll go 3.5.
Yeah.
And again, I've been calling a surprise for this month for 2 months, so I see no reason to change.
Yeah, it's very possible because of the base effect. It's very possible it'll be 3.5, but I think because of the commodities,
yeah, you're looking good.
I think we'll go to 3.4. You can see in the April-May timeframe, all the commodities went higher. That was the 3.5 number.
Yep.
In the March-April, which was the 3.4 number, commodities were, some of them went higher. Gas and oil went a little bit higher. It was actually flat in the April to March timeframe. So
very cool.
But now it's dropped quite a bit.
All right. Well,
that's my opinion. I think September will be the first rate cut, and the Fed will look like geniuses.
Well, I actually think the Fed will cut in November and have to once again react versus plan ahead. Let us know in the comments below, folks. Do you think a September quarter or a November half? Let us know your votes below. And Mr. Dan Bird, where can they find you?
By the way, well, we can talk about this in the next one. We'll talk about the stagflation stuff. And is it the 50s or the 70s?
Exactly. One more time, website is breakpointtrading.net. Go there now.
Breakpointtrading.net. There's the newsletter. I'm going to actually use the newsletter in the next video.
Awesome. Thank you so much.
Okay.